Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address is rshaw@fxcm.com, and today is Friday, the 25th of March 2022. I'm just going to bring up our high-risk scheme this morning. I'll keep this on screen for a few moments. All right, let's just bring up our commentaries disclaimer. All right, and our references FXCM Market Scope, CNBC.com, and TradingView.com. So I'm going to go ahead and just bring up the chart. We'll start off with gold, and let's just bring this. This is the weekly chart. I want to just take a look at this candle here. So we've had a good week for gold. It's a good candle. If I go down to the daily, it's really moved up over the last 2 days. The issue is that on the weekly chart is what we call an inside week. It's completely within last week's range, and that's uncertainty. So let's just talk about the sentiment and possible reason of what we're seeing here. So the sentiment is that bulls haven't had the strength or the conviction to take price higher than last week. So the bulls haven't been able. The bears haven't been able to, or they haven't had the strength or conviction to take price below last week. So neither the bulls nor the bears really having any sort of control over the market this week, and that lack of control is effectively uncertainty. Okay, so the reason we've got to ask is why is the uncertainty? And of course, we can only make inferences. And I think that the whole prospect of stagflation is still very much a question. It's not. There's no guarantee that stagflation is coming, but the odds of stagflation are shortening. And I think that gold is effectively, because it's a haven and because it is a store of wealth in a stagflationary environment, it becomes extremely attractive. So market participants just, I think, needing a little bit more information. We do see price had come down quite severely of the high of around about 2067, right? Let's take a look at the oil chart, and then I want to come back to gold, and then I want to do some news headlines. All right, let's bring up oil. I'll bring up let's bring up Brent. So I think that oil for me is the X factor. If we do see prices heading towards that ominous 150 level, then I would suggest gold probably runs higher. What we'll do here is we'll just combine these 2 weeks. So we're going to combine this week's candle, and we'll combine it with last week's candle. And the way we do that is we take the top of the range of the 2 candles, which is here, and we take the bottom of the range, which is over here, and we'll just draw that. So this is the range over the last 2 weeks. And what we'll do then is put in where the open was. The open was over here. The open was last week's open. Okay. And where's the close? The close is here. Okay. So that's something like this. Let's just put it as a candle. So this is the candle over 2 weeks, with the caveat that we've still got today to go. So this candle shape is going to change, but right now what we can see is I'll say a pseudo spinning top. Definitely more support for oil than resistance, because you can see the size of the tail. But there is resistance, so we do have a selling tail, and the real body itself, very, very short, real body. So even though there is a lot of talk in the headlines around oil, the sentiment over the last 2 weeks also has that tinge of uncertainty to it. Where the danger does come in for markets in terms of stagflation is that this is looking more and more like a higher trough over here. Okay, this is looking more and more like a higher trough, and the way we measure that is we've got the low. So this is last week's low, but it's the lowest low in at least 3 candles. And this week's candle has moved above last week's high, and it looks as if it's going to close above last week's high. Again, we're not going to know until the end of the close of trade today, but right now it is meeting the 3 conditions that we need for a reference candle reversal, right? Now, what's the big deal about these reference candle reversals is that they must be present before a swing can ensue. They don't guarantee swings. Without a reference candle reversal, you're not going to have a swing. With a reference candle reversal, the odds shorten remarkably. So any swing you show me, I'll show you a reference candle reversal. So here would be a reference candle reverse there. There's a reference candle reverse here. There's a reference candle reversal here. So the point is, if we complete a reference candle reversal here, then the odds shorten for an increase in oil prices. Now, going back to gold, just the idea here is, just before we go back to oil, 2 weeks ago we hit the high for oil. Okay, go back to gold. Right, 2 weeks ago we hit the high for gold. So you can see that this sort of stagflation environment, I think, very much represented by the way gold moves. Now, in terms of the news headlines today, I actually couldn't find the morning note on CNBC, so I'm actually referencing Bloomberg. Bloomberg sends out 5 things to start your day. And just one of the, we'll go through all of them. We'll go through all of them just so that we understand sort of the headline. So, the first headline from Bloomberg says, boxed in. Biden administration officials are worried that Russian President Vladimir Putin may lash out dangerously as Russian troops find themselves bogged down in Ukraine and Western sanctions begin to bite. The internal assessment of senior officials is that Putin's tendency when boxed in is to escalate rather than back down. Their view is that the Russian leader's choices could include the blanket bombing of Ukrainian cities, or the use of chemical weapons, or even tactical nuclear weapons. It sounds straight out of a science fiction, but unfortunately it's all too real. And if we cross that line, well, I think gold becomes extremely sought after in that type of an environment. Another announcement which can potentially push oil up, push gold up. President Joe Biden has called on the Group of 20 to eject Russia and warned again that Putin may resort to weapons of mass destruction in the Ukraine war. The president, amid a string of summits, said he and European leaders are also developing strategies to stave off a global hunger crisis stemming from the invasion of its agricultural disruptions. Biden also said that the US and its allies planned a new organization to crack down on violation of Russian sanctions, including any Chinese efforts to keep Russia's economy afloat. This all sounds ominously of escalation. Next headline, China concern. European Union officials suspect that China may be ready to supply semiconductors and other tech hardware to Russia as part of its efforts to soften the impact of sanctions. The EU is concerned that China is ready to help Putin's government weather the economic penalties put in place along with the US, the UK and Japan, with particular focus on the availability of high-tech components. So all of this seems as an ominous escalation in terms of the headlines, and I mean, we all, I think, hope for a really quick diplomatic solution, which seems, non-existent at the moment. But we want to just keep an eye on gold, see how gold is reacting. Right now, we've got that indecision. We go back to the oil market. We've got that hint of indecision, although there is a longer buying tail than selling tail. If we go down to gold's daily chart, gold's actually starting to gain traction on the daily here. Let's actually do it on this chart, not with the zones. Let's just use this as the daily, and we'll just examine. And let's take this average out. We don't need that. All right. Okay, let's do reference candle reversal analysis here. So let's find the reference candle. So the reference candle over here would be the sky. Okay, that's the last candle. That's got the lowest low. Three candle cluster. The candles to the left and the right of it have higher lows. There's the reference candle. Let's see where we are. So then Wednesday, I beg your pardon. Wednesday completes the reference candle reversal, okay, and we have big follow through yesterday. In other words, let's take a look at this a little bit more longer term. Okay, here's a fib. Okay, 50% pullback. It's found support at the fib at the 50%. It's now looking as if gold is in the sights of market participants. As the headlines get scarier and scarier, gold becomes more and more attractive. So we want to keep an eye on this. Sorry, my system's just hanging because the cash market's just opened. I'm just going to take a question here. Howard's written a question. Let me just see. Hey, Howard. Morning. Morning to you. Nice to have you, as always, on the webinar. Right, let's just acknowledge the stochastic has crossed positively. RSI has moved above 50. If the stochastic starts heading towards the upper quintile and holds, then there's an underlying momentum on gold. That would suggest to me that geopolitically, things are deteriorating. So let's just keep an eye on that. At the same time, I want to take a look at the dollar, and then we're going to go through to the DAX. So let's have a quick look at US dollar here. So what's happening to the US dollar? Let's just go through to the weekly. There's a resistance. Okay, so it's tackling resistance here, and the resistance. Let's make this a red. Okay, so where did this resistance come in? Where did this resistance come in? 2 weeks ago. Okay, so perhaps that has some sort of intermarket linkage. My assessment of the dollar is that there is my opinion is, so it's very much opinion, is that there's a tug of war now between the US dollar and gold. That's what I think is happening. And the reason is because there is stagflation on the horizon. Hopefully, we don't go into a stagflation environment. It's very painful to go through a stagflationary environment. Unemployment will get worse, and and policymakers won't be able to do much about that. So if they focus on creating jobs, then prices skyrocket. So we have huge inflation. So that's the pain there. If they focus on controlling inflation, then unemployment worsens. So there's the pain there. That's what stagflation is. It's a paradox. It's an economic paradox. So if in that environment, if we go into a paradoxical environment, I would suggest gold, becomes a very sought after instrument asset. If we manage to avoid it, let's just say that the diplomats managed to all sit around some sort of table and flesh out a de-escalation and an agreement, which is a pipe dream at the moment. But let's just assume that is what happens. Then I think gold becomes less sought after. Then monetary policy becomes a key focus. If monetary policy becomes a key focus, then the dollar becomes a key focus, because the monetary authorities are looking very hawkish in the US. And I think that's why you've got this resistance here, because if we do get closer to that stagflationary environment, monetary policy at the moment, the Fed has indicated that they are looking to focus heavily on the inflation side. Now, if they're doing that and we do go into a stagflationary environment, that unfortunately is going to hurt unemployment. So they sort of the hawkish interest rates bring in a recession. That's what stagflation does, and I think that's why the dollar market here seems to be just considering how hawkish the Fed can actually be. And the truth of the matter is there's still so many unknowns in terms of whether the stagflationary environment arrives or not. So that's why we're not seeing sort of a pullback. We're just seeing reactions off of that resistance level. We'll carry on. We'll keep an eye on it. So that's just my sort of reading of the market, subject to correction. So I think there's this tug of war going on between gold and the US dollar. Now, just the last instrument we're going to look at is the DAX. So I'm just going to bring that up, and I just want to do a top-down analysis here. So the idea with the DAX is we are in a downtrend, and the reason we're in a downtrend is because of peak and trough analysis. We've got a lower peak followed by a lower trough. Let's just take these all out because I think they're confusing. The question is, what's happening here? What's happening here? Because clearly, if you had bought the DAX over the last 2 weeks, you're doing fairly well, except of course if you bought at this level. Now we've got to be cautious here. Yes, this could represent really good value. It could, okay? The DAX is made up of quality companies. That means the cheaper the price, the more value there is in terms of the quality names. However, okay, there is something that we've got to understand. When we're looking at market risk, okay, there's generally two types of market risk. We look at something called systematic risk. I'll explain to you what that is in a moment. I'll give it another name to make it easier. Or market risk. Okay, That's the one risk. Systematic is called market risk. Then we have something called unsystematic risk. Let me see if I can spell this right. Unsystematic risk. That's called company risk. Okay. So these are the two types of risks that we as market players, when we go into the stock market, are dealing with. The truth is that the company risk here may be not that bad. In other words, we may have companies that have sort of streamlined to operate in heightened sort of times of uncertainty. We may. I'm just throwing that out there. It doesn't matter. Okay, this we can delete. This we can delete. That's not the problem. The problem is this guy. Okay, the market risk. So if the market risk tends to heighten, okay, then this over here, I didn't spell it right. I left out a T. Systematic. Okay, then what I want us to do as sort of attendees of this webinar is keep an eye out for the possibility of the next lower peak. It may not happen. We may have a tremendous rally that takes out this. I'm skeptical of that, but it could be proven wrong. Now, if there is a lower peak here, okay, then the next part of the analysis becomes extremely important. It's crucial. Does it pull back and give us the higher trough into the high? That would be the best case scenario. That means the markets are recovering. That means this is a good place for value, okay? But if we get a heavy fall down and we get a lower trough, we're in a severe bear market then. That's trouble. Now, let's go through to this over here. In fact, I want to go through to a different layout. I want to go to my insights layout. And I want to go through to DAX here. And this is the trouble. It's much easier to see on this template. Over the last week, the last 7 trading sessions, the DAX has been unable to take up 14.5. Okay, we've been unable to take 14 to the point now we have actually reacted quite severely off of it. We're at the border of zone 1, zone 2, the bullish neutral area. If we drop from bullish to neutral, that's a sign of weakness. Take a look at the hourly. Hourly starting to roll over. I'm fearful, I'm just going to go back to the main layout. I am fearful that we are in the midst of a bear market rally. Now, it's not the bear markets that hurt, it's the bear market rallies that hurt. They tend to suck us in to what we believe is good value, only to smash us on the way down. That's where the damage was done in 2008. If I can just go back to 2008. There we go. This is the global financial crisis. This is where the damage was done. Guys thought they were getting in really good at good prices. Yeah, can't get possibly lower than this. Okay. This must be the absolute low. Okay. Continue capitulation. It's the bear market rallies that suck us in, and of course that's where they do the damage. Now, clearly, the economics on the ground, the fundamentals on the ground, are completely different between now and 2008. Over here we had a subprime crisis, whereas right now we're having huge geopolitical escalations that are potentially ushering in stagflation. However, if you go through any bear market, you know, going all the way back to 1929, it's the bear market rallies that do the damage. It's the bear market rallies. Now, I don't know if this is a bear market rally, but I don't want us to just discount that. I want to discount that. Okay, there is systematic risk. Now, there is something else to be said about systematic risk, and then Howard is just asking if we can take a look at Bitcoin, which we surely could, and we will. When you're building up a portfolio, or when portfolio managers are building up a portfolio, they're looking very closely at what's called the correlation coefficient. Okay, because if you have a portfolio that has instruments that are non-correlated, they're uncorrelated. So where's this? So the correlation coefficient is bounded by +1 and -1. Okay, it can't get higher or lower than. So it's a very nice way of looking at correlations as opposed to other measures such as covariance. The correlation coefficient, if you've got something that's perfectly correlated at +1, you've got no diversification. It means that if you've got two instruments and they are both perfectly correlated, they're going to move up together, they're going to move down together. You've got no diversification. That means that if they both go down, you're going to get hit double as bad. If you have got a portfolio sitting at -1, well, then you're perfectly inversely correlated. Well, that's no good either. You've got no risk because as one goes up, the other one's going to go down perfectly in the same step, right? But they're going to cancel each other out. So you've got no risk. You've got zero risk, but you've got zero chance of reward. So one may go up 50%, the other one's going to go down sort of 50%. You're net zero. Okay, so that's not good either. So what portfolio managers are trying to do is they're trying to get as close to zero as possible. Okay, so non-correlated. You want to try to build a portfolio as close to zero as possible. Now, that's all fine and good in a bull market. In bear markets, instruments tend towards, sorry, I've done this wrong. They tend towards not -1, they tend towards +1. Okay. In other words, all instruments tend to get hit in a bear market. So the systematic risk here is huge. So if we're seeing a bear market rally here, that could be across the board, because in a bear market we tend towards +1. All right. Having said that, let's take a look and see what Bitcoin's doing. See if it's got similar attributes. So I'm just going to bring up Bitcoin here. All right, so this is an interesting chart. I must confess, when we write articles for Insights, we do tests to see which articles are the articles that have been accessed the most, and the cryptos, especially Bitcoin, are outright winners. For some reason, there is an infatuation with Bitcoin at the market. A chief marketing officer said to me, "It's a cryptocurrency world," and he's probably right. So it's just out of interest. So we try and get sort of Bitcoin or crypto articles out quite regularly now. Just it makes sense, because those are the articles that people want to read. What we've got to deal with here in terms of Bitcoin is this triangle, and we're on the weekly now. The how it's telling me I better get some. So it's no secret. I'm not a Bitcoin fan. I'm not a cryptocurrency fan. Again, I could be behind the curve. So how it's just like, "Hey, Russ, you better get some," and he could be right. Look, let's try and do this as objectively as possible, right? And I think that to help us, or help me be objective, I'm going to introduce a 30-week exponential moving average. I'll tell you why at 30-week in a moment. It's a generation thing. I think that's you, Anna. Is that you? Because it says here just waiting for name. It hasn't come through. Is that you? Yeah. Yes. Okay. Yeah. It's a generation thing. It definitely could be. All right. Look. Let's put in a exponential moving average here. And I'm going to make this a 30. I'll tell you why in a moment. Again, it's not a magic number. I tend to actually use 34, which is again not a magic number. But if you guys go out and you buy a book, it's an old book, written in 1987 by a guy named Stan Weinstein. It's got quite a sort of cheesy, corny type of title called "Profiting in a Bull and a Bear Market," but the content of the book is brilliant. It was the first book I ever read that I read when I really got into my technicals. And if I just stopped there, I would have had so much more knowledge than if I'd carried on, because you start getting poisoned by all the extra knowledge. You know, he really kind of distills it down into a really good system. Anyways, you can get it off Amazon. But the point is, what Stan Weinstein does is he looks at the market in terms of a model. This is what he would call distribution. He would call this the markdown phase. He would call this accumulation, and he would call this markup. And then we would go back into distribution. Now, that's only one of two models. So this model here is called the value model. Stan's book only goes into value. There's also a growth model. We won't do the growth model right now, but the question that we've got to ask ourselves is, I'm reading your notes here, Anna, and so Anna's, she's given me her age, which I politely am not going to tell the group, but she has stated that she's infatuated with Bitcoin. That's fine. Look, as I say, to me, I'm not sure about the intrinsic value. Anna said it could be a sort of a generational thing, and she could definitely be right. I'm not certain about the intrinsic value. I've got to get my head more around it. But the technicals represent fundamentals. Okay, technicals represent fundamentals. So if the price is going up, one would suggest that it's hopefully based on fundamentals. If price is going up and it's not based on fundamentals, that's an accident waiting to happen, or it's market manipulation, right? So we've got this accumulation pattern over here, and then Weinstein's in a 30-week. He puts in a weighted moving average. So we'll use an exponential moving average, which is a form of weighting in of itself. I don't think it makes much difference. And he uses in the book a 30-week weighted moving average. The point being that for the accumulation to complete, he wants it to get over his 30-week moving average, and he wants the moving average to turn up. So you can see we've still got this triangular accumulation. And I've got here, well, is it continuation or accumulation? Continuation, I mean, is it going to continue the downwards pattern? So if it breaks out, okay. But what's interesting, of course, is what happens if it breaks up? And what happens if the moving average turns up? Well, then there has to be some sort of accumulation taking place, right? And the question is, well, why is there accumulation taking place? Now, true technical analysis doesn't really give much importance to answering that type of question. What technical analysis is saying is that price is discounting the fundamentals, which I largely do believe. Okay, there can be exceptions. So the exceptions can be in a market which is unregulated. In other words, there can be manipulation. Bitcoin may be one of those markets. Now, I don't know, and that's just sort of the bad side of the argument. The good side of the argument, if there is imperfect information, then you've got a better chance of making an abnormal profit than in an efficient market. So there's two sides to that argument. Let's take the second side of the argument. Let's say that we are reading information here that other people don't have. Well, all other people are saying, well, Bitcoin, okay, is just going to be hammered because there's regulation coming in, which is an argument and a debate in of itself. What happens if Bitcoin crosses above the moving average and that moving average turns up? Well, that's Stan Weinstein's accumulation pattern being completed. He would also suggest then after the breakout that there is often a pull back towards the 30-week moving average, and then the true markup stage starts. So we'll watch it, I guess, in that vein. Again, the fact that we're at the upper part of this consolidation is bullish. And number two, we want this. So Bitcoin bulls want the stochastic to get up to 80, and then we'll have a breakout and some underlying momentum. The fact that we have the RSI at 50 right now is not surprising. Okay? At 50 is neutral. Okay, the fact that the stochastic is kind of in no man's land is not surprising. It's kind of neutral at the moment. Well, why are we neutral? It's because we're moving sideways. We're consolidating sideways. So RSI crossing above 50, stochastic moving up towards 80, price getting above 30-week, and then that 30-week turning up. That's what the crypto bulls want. If that happens, well, that in and of itself going to make for interesting analysis for me, because I'm going to now get my head around it. Why fundamentally would that be happening? So dare I say it, maybe US dollar getting hurt here because of the stagflationary environment. Bitcoin perhaps being sought after as a safety asset. I find that one hard to believe, but I could be wrong. Is it maybe that Bitcoin is being accumulated to circumvent sanctions? Maybe that makes more sense to me, but again, this is speculation. So if we get above the 30-week moving average and that turns up, that's going to be an interesting crypto minute, which we have every Wednesday, because yes, the technicals look very good, but that's not good enough for us, guys. We have to understand the underlying reasoning for that, and that's going to be the challenge. Anyway, so we'll watch this market. By the way, if we do go down to the daily, you can see that it has moved comfortably into the bullish area. If we go down to the hourly, okay, there seems to be some sort of support at the central pivot. Okay, so we'll keep an eye on that. All right. Are there any questions that I've missed? Howard's just saying it's high risk, very volatile. Yes. And also remember, if that market risk, that systematic risk expands, it may hurt Bitcoin as well. It may. We'll have to see. I mean, we didn't have it in 2008 to draw some sort of comparison. Any other questions? Guys, I think I'm going to wind up here. If there's any questions, you can just shoot me an email. You guys have my email. Thank you so much. I believe the times, European times, changing this weekend. So for anybody in ZA, that means we're going to have the webinars an hour earlier. For those sort of that do change their times, that's no change. All right, thanks guys. Have a good weekend, and we'll chat on Monday. Thanks guys.